What's up, guys? Today I'm going to talk about FHA loans. Now, a lot of people think FHA stands for like first time home buyer authority or association or something like that. And I can see how you would draw that conclusion because usually when somebody is buying their first property, somebody in the family or a real estate agent is going to give them some direction. Go get an FHA loan. It's the least money down you need to put on a property. So I can see where that conclusion will be drawn. However, FHA loans are not just for first-time home buyers. And what I want to do today is I want to kind of go into the details so you can make an informed decision on if the FHA loan is right for you and your family. Me personally, I have funded hundreds of millions of dollars in mortgage transactions. And as a VP of a bank, I've seen over $500 million in mortgage transactions. So I can confidently tell you that there are some really great benefits to this program, but there's also some downfalls, and you need to be informed. Stick around, I'll get into the details. First thing I want to talk about, I just want to do a little bit of CYA for me. I got to tell you, I am not quoting you any mortgage rates. I'm not offering any type of finance to you. I'm just giving you a bunch of hypothetical scenarios so you can make an informed decision. This is not an offer for financing. I'm definitely not offering to give you some sort of pre-approval. Now that I've gotten that out of the way, the first thing I want to recommend to you, if you are looking for some sort of loan product, if you're wanting to buy or refinance a house, is to work with a mortgage broker. Now, I did a whole nother video on what mortgage brokers are, what they do, but here's what you need to know. When you work with a mortgage broker, the mortgage broker is going to take your loan, your unique scenario, and they're going to go shop that out with a bunch of different banks. And they're going to say, what does your rates look like today? What does your rates look like today? And what does your rates look like today? And whoever has the best rates, they're going to get the deal. So they're going to actually go and shop your loan on your behalf. If you're working with a big box bank, it's basically one size fits all. And here's the thing. A lot of times these big box banks, they can't do things that mortgage brokers can do. We have access to bank statement programs, and we have access to programs that go below 580. A lot of times, 580 credit score, that is. And a lot of times I get calls from my buddies who work at these banks saying, hey, Johnny, can you do this loan? I can't get this borrower approved. We have an offer. We have an offer that's been accepted and their credit score dropped below 580. Can you close on this? And then I'm then able to take that loan and bring that to a bank that works with borrowers below 580 in order to help close on that property. So there's a lot of benefits working with the mortgage broker. Check out the other video that I made if you want details on that. And if you want to get pre-approved, there's a link in my bio. I only work in certain states. I'm only licensed in certain states. However, if you are in one of the states that I don't work in, I can give you a great recommendation for another mortgage broker who can help you out. Okay, there's that. Now let's talk about FHA loans. So here's the benefits of having an FHA loan or getting qualified using an FHA program. The very first thing is that you only need 3.5% down. So if I'm buying a house for $100,000, I only need 3.5%, which is $3,500. And that money I can go borrow from somebody else. Hey, mom, you got $3,500 I can borrow? I want to buy this house. FHA loans allow you to borrow that money in order to buy a house. And this is a really great benefit. And of course, there's a ton of benefits to only having to borrow 3.5%, right? If I'm doing a conventional loan, I need at least 5% down. So the next thing is going to be around credit score. So here's the thing. You'll hear a lot of people saying 620 and above is for conventional and 580 to 620, this is going to be for FHA loans. Now what you should know is that you can actually get qualified for an FHA loan below that 580 threshold. The caveat is going to be if you have a credit score below 580, you probably have some late payments somewhere. This could potentially disqualify you, but not all the time. So it's not a one size fits all. And this is why you'll talk to maybe a loan officer and they'll say, look, I don't know if I can get you pre-qualified. I need to pull credit and I need to look at certain things in order to see whether or not we can get an approval. So the next thing is going to be around debt to income. Okay, now what is debt to income? At 30,000 feet, debt to income is basically the money coming in versus my money going out. So in a hypothetical scenario, Johnny makes $10,000 a month, and then every month I'm responsible for my credit card payments, my car payments, of course, the mortgage and the taxes and the insurance as associated with my housing expense. And let's say that's $5,000 a month. So I've got $10,000 coming in and I've got $5,000 going out. So my debt to expense ratio is 50%. 50% of my money is going out. Now, FHA has looser guidelines, meaning I can have a higher debt to income ratio as compared to some other programs like a conventional loan program. program, okay? And I don't even want to give you a ratio. Just use the number 50% as a round number. It's always moving. With an FHA loan, your debt to income can be higher than it would be in a conventional loan. So I want to talk a little bit about why somebody who is a current homeowner might refinance into an FHA loan. Okay, so let's say you buy a house and you've lived in the house for, I don't know, 5 years, and you start building some equity. I would say call it 10 years, okay? You build equity, however many years. You build equity. You've got $200,000 in equity in the property. But over that time, you've also run up your credit cards. And when you run up your credit cards, what happens? Your credit score comes down. So your credit score comes down, you're at, 600. And you're thinking, well, can I even refinance? I'm not a first-time home buyer. FHA is first-time home buyer, right? A lot of people, this is a big misconception. They think FHA loans are only for first-time home buyers. So they think I can't qualify for this type of program to do a refinance. Wrong. You can refinance into an FHA loan even if you've owned several homes. It doesn't make a difference. So now you're in a situation where you have this credit card debt and you have this equity and your credit score is maybe below that 620 threshold, and maybe an FHA loan is the only option for you. So what we do in these scenarios is we actually do a refinance and we pay off all those liabilities. I don't say we, the homeowners actually do it. They take their equity and they pay off their liabilities. And then what happens when they pay off their liabilities or their credit card debts? Because they've paid them off, their credit score goes up. So they make, several payments on that FHA loan. Over time, their credit score builds up. Maybe it goes up to a 700. And now when it does that, we can turn around and say, look, Mr. Borrower, we're going to do a rate and term refinance and put you back into a conventional loan. And generally speaking, we can lower the interest rate by doing that. So we've accomplished a couple things. We've paid off we've helped them pay off all their liabilities, all their credit card debts, or whatever it is that they need to pay off. And then we get them back into a conventional loan and usually get rid of the mortgage insurance that's associated with FHA loans. Next, I'm going to talk about mortgage insurance, what that looks like, and why that's maybe something that's not so great about FHA loans. Okay, so let's talk about mortgage insurance. Now, whenever you take out an FHA loan or use an FHA loan to buy or refinance a property, you're always going to be subject to two types of mortgage insurance, okay? And you might think, oh, that's great, I have mortgage insurance. If I can't make my payment, the insurance is going to make the payment for me. Wrong. The insurance is not for you. It's actually for the lender if you don't make your payments, okay? So you are not actually insured, but you are responsible for making the premium payments. So the first type of mortgage insurance is going to be an upfront mortgage insurance premium, which means at the very beginning, you have to pay an upfront amount. That amount is 1.75% of the loan. So if it's a $100,000 loan, it's $1,700 that you have to pay for that upfront mortgage insurance, okay? Now, that can be rolled into the loan, which means when you actually take out the loan, your loan is going to be $1,750 higher on a $100,000 loan than the money you actually borrow. They're just going to add it on the top. The second is going to be your monthly mortgage insurance. So the way this works is, again, your loan amount is $100,000, and the insurance amount is going to be 0.55% of the loan amount over a year, paid monthly. So let me break that down. The loan amount's $100,000. So $100,000 times 0.0055 gives you $550 a year that you have to pay in mortgage insurance payments monthly. So $550 divided by 12 is going to give you $45 a month that you have to pay for your monthly mortgage insurance. If you have any questions on anything that I've shared, you can always email me. My email is in the description, or you can share it in the comments. That way, if somebody else has the same question, I can kind of address it for everybody. Remember, with mortgage, things are always changing. I talked about the monthly mortgage insurance being at 0.55 of 1%. If I was making this video a month ago, it would be 0.85 of 1%. So everything's always changing. That's why a lot of times the internet is not really a great source of information when it comes to mortgage finance. I always tell everybody, talk to a mortgage broker or talk to somebody who's in lending, because Google is not really a very reliable place, because things get outdated very quickly as new programs get introduced and old programs go away. If you find that, or if you have found that I provided some value, I would love for you to like this video. You can share it with somebody maybe who would find some value or benefit. Maybe somebody who's looking to buy a house. And for sure, if you're somebody who's in the real estate space, or you're into real estate investing, or you want to get into real estate investing, I would love for you to subscribe. I'm sharing a lot about real estate investing on this channel too, trying to provide as much value bring awareness, and just share my knowledge. I appreciate your guys' time. Have a great day.